tools, and the time of day functionality, you know, without the benefit of having charts and oscillators and other types of tools. So it was very much dependent on time of day, and you could get a good sense, and I'm sure except for today, of course, you kind of get this feeling of the tide going in and the tide coming out. And so, you know, that type of rhythm during the day would tend to set up 2 to 3 tradable swings, and each swing would have anywhere from 30 minutes to 1.5 hours of duration. So for me, day trading was not something where here's a little 5 minute candlestick and I'm trying to do this bar by bar processing, which, you know, I probably would not be able to do. It's very tedious, and I like to trade too many different markets, and I would probably end up getting tripped up in the noise. Although I do have a friend who's very good at doing that, but it took him 10 years to get good at doing that. So I'm going to just let you know I started off on the floor with the time of day functionality. When I did get my first charting software, it was in 1987, a program called Insight. And at the end of each day, I used to print out a 5 minute chart with the oscillator below it and ticks plotted below it. And I did this for a year, and I would simply circle what the turning points looked like. And also, when I was still at the exchange upstairs, I would write down readings every 5 minutes of the S&P price, the bond price, because in those days there was a very strong positive correlation between those two markets, and we didn't have the NASDAQ futures and things like that, and so it really, and write down a few other things. So it really honed my eye on the tape reading side. So now I've got the charts that I'm printing off at the end of the day, circling these things, and it was a little bit of a process. You see what I'm saying? So I'm trying to convey to you that my learning curve was a really long period, a long evolution. And so I want to boil it down to the main things that are pertinent today if you're going to start day trading these S&Ps, and you aspire to get consistent and make a good amount of change, not just, 2 steps forward, 2 steps back, which is what happens if you miss out on the ability to put things in context. So type of day is always going to be an important consideration. What do I mean by type of day? I am simply looking at, is it a trend day or is it a light range rotation today? Obviously, today was not a trend day. It was the opposite, a very narrow, choppy, whippy day. And this is the type of day that can lead to a good trend day tomorrow. So we'll see how that plays out. So that's number one consideration. Some people like to look at auction theory, market profile to sort of categorize, the type of, is it a test reject type of day? I am not so much of a market profile person. So for me, type of day is coming in, do we have a preceding condition that is a breakout pattern? The narrow range and so forth? Or have we just had a big move and we want to be in a consolidating mode? Because it's all going to depend on the strategies that I use. So first of all, we want to learn there's about 6 basic type of days, and all you need to do is keep a little notebook. Keep a little notebook and write down your observations every day and write down your expectations for the next day. That is the best approach to learning. Second of all, levels in play. For me, the important levels in day are always going to be the previous day's high and low, and we'll look at that, as well as the Globex high and low. And then lastly, the opening price. So those are the main levels that are critical for me. time of day considerations. We'll look at one or two of these today and give you an idea of the power of some of these time of day considerations. And again, if you are newer to this business, it is essential that you take a notebook, write down your own observations, sort of draw out a swing chart during the day and note, the high, the time that the high was made, the time that the low was made. And the more that you can do your own work along this way, instead of relying on a gimmicky little indicator or strategy, I promise you that the deeper understanding that you will gain from doing these types of exercises on your own. Okay, market internals. For me, that is including the volume. So, right, very first thing I want to see, do we have good volume? Today was just average volume. It was slightly better than yesterday, but kind of marginal just compared to the last couple days. So it was unlikely we were really going to go to any new value area. We had to sort of digest where we were already. So we've got volume, we have some market internals that we'll look at. The ticks, do they serve us or not anymore? They do in certain times. The VIX and the VIX can be very important indicators. So those are always helpful. Chart formations. Now we can start to add some context and look for specific chart formations. I'll show you exactly what I look for. And lastly, confirmation, non-confirmation. So these are the basics. If you want to be an S&P day trader, you can start off, of course, by having one little pattern to get you started, because the execution part of it is really a big part of it. It's an understated part of it. So if you had one little small 5-minute candlestick pattern, and I did a previous webinar on this that I know that you can tap into if you go to my website and look under resources, you'll see all the previous recordings I've done. And sometimes these little funny candlestick patterns can get you started. That's important, but it's unlikely that you're going to make a good living from them, at least for the first couple years. So I want to show you just things to keep in mind as we move on. Now, day trading. Why am I starting off with a chart that shows 24-hour worth of data? And what I want to show you is that we divide the 24 hours into 3 sessions: Asia opening, Europe opening, and US session, which I actually, for all my modeling purposes, use the 7 a.m. Central Time reading as the start time. And then of course, I am conscious of the time of day for the NYSE opening, which we'll get down to. But I want to show you why this is important first. It helps us assess also what type of day to expect when we come in. So you'll see here, these orange dots are the start of our US session. And it is extremely rare that we get 3 trend sessions back to back. So for example, here you can see our US session opened and we pretty much had a trend day up. We rallied up and closed at our highs. And if we look at the 2 sessions preceding that, you see here we had 0 trend, a little bit of chop and a little bit more chop. So 2 preceding sessions of chop, and then we get our trend. This law of alternation exists in the daily bar charts, but it also exists from the sessions. So I'm always mindful of this. You can see now we rallied up into Asia opening, and we sold off in Asia, and we sold off in Europe. Now we have the US session. We open and we do the test reject pattern. It was really unlikely that we would close on our lows 3 sessions in a row. So that's something that you can just look at. It takes 1 minute to check it in the morning. I check it with the currencies, with the gold, with the crude, with all markets, and believe it or not, it works great on these S&Ps. Now, everybody says, dang it, all the movements happening in the overnight session these days. Well, yes and no. We model the amount of each day's range, and then we model the percentage of that range that happened in the US session. Now, granted, it has gone down, but I think you would be surprised to know that if we took the whole S&P 24-hour range, you still have the largest percentage of that range in the US session. So even though we had a very marginal choppy day like today, this was just a week or two ago. And you can see here that the S&Ps opened and we had trend down. We went sideways, a little bit of a trend, and then we had the open and trend down. So far you can see off of these orange dots that these sessions are much greater range than the Asia session or the Europe session. Here we have open US, rally into the close, sideways Asia, sideways Europe, which once again sets up trend down in US session. So you see these little subtle nuances. The reason why we want to look at the big picture first is that we want to be thinking about getting the main idea right. And that is part of this Taylor is it going to be a low to high day or is it going to be a high to low day? Okay, if somebody told you the trend for the day, think how much easier it would be when you get when you get caught up in all these little 1 and 2 and 5 minute charts and overkill with this stuff. So in the big scheme of things, we want to not only have some mild edge on getting the directional bias, but we also need an edge. Is it going to be a range expansion or range contraction? Obviously, today was a range contraction day, and it would be a very easy day to overtrade. It would be very easy to think there's going to be an upside breakout or a downside breakout if you didn't have some type of bias given from the market internals and the volume and so forth, that the S&Ps were probably going to remain a range day. Not so with the small cap index, the Russell, which closed on its highs. But my main point here is I wanted to point out that we've got sideways trend, big trend, and we're still seeing enough movement happen in our US session. So don't give up hope if you have a day like today. Now, moving on, type of day. This is back to what I was talking about. I just put up S&P pit session data only. Now we are talking. And you can see back here, we had a trend day up, meaning low to high and pretty much a steady grinder up. These lines here are plotted automatically. They are the previous day's high and low. So this was a trend up above that previous day's high, and we opened up and rotated. So multiple times we flipped back and forth through the opening price, and there are wonderful strategies for taking advantage of this, and they are completely opposite to the type of strategies that you would be trading if you knew it was going to be a trend day. So you see already the if you're not putting the big picture into context and just trying to trade off of little 5-minute oscillator patterns, and you don't have the tools to know to when to switch from one mode to the other mode, all right, it's it could be tricky. And there's so many little wonderful nuances with this market that's I still keep notebooks. I still write down my observations and notes almost every day. And here's just another good little reminder is that the counter trend moves happen more frequently in the morning session, never fade an afternoon trend. So, for example, if our last hour was rallying here, you don't want to be looking for little cell divergences or a reversion to the mean type of strategy. And conversely, even though we were in rotation in the morning, once we broke in that afternoon session, that is the true trend. Okay, moving on. I wanted to put up a tick chart here. Now this shows more continuous data. This was actually yesterday's data. So what I do on my screen is for the opening of the session, I always have the previous day's high and low plotted. If I could trade with only one indicator, it would be that previous day's high and low. These are what are called decision points. And the reason why they are so important is this is where you have, first of all, increase in volume or support or resistance come in. They are the most visible chart points for all market participants. You know, nobody sees Fibonacci, or, trader pivots. I mean, I can't imagine Paul Tudor Jones, looking at these things, but everybody knows the previous day's high and low. So they're very strong psychological markers. And you can see yesterday, I plotted our opening price here with the little dots, and we rallied right up to the previous day's high and fell short of that early morning Globex high. So that was still a hanging data point up there. And indeed, we sold off and perversely tested that opening price to the tick. And then we went up and got that Globex high. So for me, I find these incredibly helpful. I'm just trying to give you little pointers and tips, and I'm sure most people that have been trading the S&Ps for many years already know these things, but you have to know some place to start if you're newer to the game. So let's just look in a little bit more detail at some time of day nuances that you can start to be conscious of, as well as these previous days' high and lows. So, one important time of day function for me is the top of the first 30 minutes. And this is the point where you're either going to get the morning check mark. So this to me is a test reject. So we sold off into that 9 o'clock reading and found support. So that's your check mark. And of course, it was the little bit of play around that previous day's low. So very important level. We either tend to get the check mark on that first push off the opening price, or we'll get the pause and a continuation pattern. So this, for me, really sets a whole tone for the day. You see, I am not cherry picking these charts either. They were just all in the last week or two. So here was another case, the opposite case, where we opened and we did our morning check mark. So there was a good reversal play there. And then we came back up and tested the previous day's high. In both of these cases, I wanted to point out that you had opposite outcomes in that last hour. So one, the outcome was an upside bias, and one, the outcome was a downside bias. So when I am day trading the S&Ps, my time horizon tends to be just for an hour and a half out at most, sometimes 2 hours. In other words, I'm so used to looking for perhaps here's one play, perhaps here's another play, maybe I missed this play, and maybe here's another play. So there's usually you can kind of see if you drew a Z, just really crude. And there's so much noise these days. Take off your glasses and pretend you're seeing them with like demented sight, okay, and then it'll make a little bit more sense. But back to what I was talking about, that feeling of the tide goes out and the tide comes in, and the tide goes out and the tide comes in, and the tide definitely went out in that one. Okay. And this was an interesting one because you had both the test of the previous day's high. You see a little bit of an open test reject, although let's see, 1, 2, 3, 4, 5. That was 25 minutes into it. And we did rotate on both sides of the opening price. Do you see that already? Morning session, rotate, 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 rotate. And then when you make new lows in the afternoon, that is a strong shorting signal. And I guarantee that all the big money at that time had this level in their radar, the previous day's low. Okay, don't want to elaborate on this too much more. Let's go down to a few more slides. And I am really blessed because they stuck me at the end of this. So I have all the time in the world for questions. So now I wanted to throw in one or two more monkey wrenches here. First of all, I wanted to add some market internals. I don't have any charts where I'm showing the volume. I don't ever plot volume of the S&Ps. I look at volume for the NYSE at the top of the first 30 minutes just to see the overall money flows. In other words, if the mutual funds and the hedge funds and everybody is buying stocks and driving that market up to a new place, of course these S&Ps will be carried along with it. I don't want to analyze the volume on the actual futures contract, and the reason for that is if you have a very large gap up, you'll notice that you tend not to see any volume in the S&P futures, not nearly the same way that you would in the individual stocks. And there's just some other quirky things there. I've never found it really served me. But let's look at some of the things that I do find value in. Particular these days, this VIX or the VXX. Pick your poison. Some days one is better than the other, but they all are going to pretty much confirm the trend. So I find them to be more of a smoothing type of indicator, although that was not the case today. Um, and you can see, for example, on this yellow VIX at the bottom of this chart, how smooth and steady this markdown was in general, while you still had little wiggles and jiggles and so forth in the lines. And this actually was a pretty steady trend, so I don't want to exaggerate there, but it kind of is a good readable swing. So a lot of times when I am tape reading, I'm looking for the VIX to turn up or the VIX to turn down. I want to think about it, stop going up or stop going down. And then one of the strongest signals that we can get is if this VIX takes out that early morning. I don't ever look at it right at the opening, but if we see this VIX make new lows in the afternoon like this, or new highs, that to me tells me just buy. Close your eyes and buy, because there's 90% chance that it's going to close higher, or inversely lower. So that's one of the things that I look at with the VIX. There's no real leading or lagging edge. You could probably plot an oscillator on this and come up with the identical patterns inverse that you would with the futures. The second thing is ticks. Now, I love the ticks. They've been my primary indicator all my life up until the last couple years. And I'll tell you what's changed. First of all, the ticks went through a huge adjustment when stocks stopped trading in eighth. So if you read that Market Wizard book where I was talking about looking at the ticks going, down for a flush and then bouncing back up a little bit, that whole game is no longer. The tick fades looking for the bounces. You have to be very careful about that because that was when stocks were in eighths, and you would get, if just 25% of the stocks in the NYSE did an uptick or a downtick, it would be enough to move the futures 2 or 3 points, which was a big move back when we had 7 point ranges in them. Okay, so they still have value, but we need to put them in context. On a trending mode, they can serve the same purpose that an oscillator does, meaning a momentum indicator. I want to see those ticks making new highs in the afternoon when the market is breaking out. Really good, powerful pattern there. And the other thing is we can also look at them for the tick divergence. Now, I do this on a 2 minute chart, and I get 3 trades a week in general. And for me, I like to see the divergence also confirmed with an oscillator divergence. So you see here, the ticks made a lower low, and the oscillator made a higher low, and the ticks made a higher low. And I will do that trade blindfolded every time. Whoops. So that is a staple little fun trade that is good to go. Now I wanted to also show that we closed here and we opened here. There was not a large opening gap. Sadly, the ticks are of very little value in the morning session after a large gap up. So I don't pay any attention to them at all. And the last little caveat is be careful with the ticks, with the Russell when it is in a very strong trend, because the small caps, the broad market, is what's really the driver for the market breadth. And so there can be a little bit of a distortion there sometimes when this Russell has come to life. But let's just go back and note that we didn't have a large opening gap here on these S&Ps from the previous pit session. And so therefore, that's why the ticks were such a better trading tool. And you see, note the correlation here. You see the oscillator peaks and the oscillator dips. You see how they are almost nearly identically correlated. Okay, this is in a perfect world how my perfect world would be, where they were correlated all the time. But like I said, when we have large gaps, they are not. So here I wanted to point out that if we looked at our 9 o'clock reading, remember I just showed you 2 examples of that morning check mark. And here is the opposite case where we sold down, we did the consolidation, and it turned out to be a continuation pattern. So this is the important inflection time of day point. And like I said, I am not trying to predict the day. I'm just trying to predict a trade for the next 30 minutes to 1.5 hours. That's sort of my average holding time in these E-minis when I am in the full tilt boogie. So now let's just move on. That was just a little taste, an ice cream cone taste of the market internals. And we can do so much work in this area, but let's get down to the bread and butter. Okay, now we're going to start looking for chart formations. And this is what I look for as we approach one of these decision points, which could be the previous day's high or low, or perhaps a gap area, or perhaps the Globex high or low. Some people even use these decision points with market profile work, for example, a large volume node. So that's what we call decision points. It's where the market is deciding, are we going to see buyers come in or sellers come in? Or are we going to knife through this point like a hot knife through butter. Now, I just put up two time frames for you, and unfortunately, I've got the wrong caption up here, so ignore that. Okay. Whoops, that was just an oversight on my part. But what I should have up here is pointing out how much easier it is to see the swings on the higher time frame. So once you go down and you see an oscillator with too many little wiggles and jiggles, this is a simple moving average oscillator, the difference between a 3 and 10. You could put up a stochastic here, an RSI, pick your poison. It really doesn't matter, and I'll show you why at the end of this. But you start to see all the little wiggles and jiggles, and the reason is because now we are down to a time frame where there is too much
15 minutes and
noise.
we have
And this is
overcome
what
that
tends to
noise and
trip
we have
up
the true
newer
swings.
beginner traders is this noise level, and particularly on a day like today. But all we have to do is jump out one time frame, 15 minutes, and we have overcome that noise, and we have the true swings, at as our roadmaps. I like to call them roadmaps. So I always try to find a higher time frame. It could be a 15 or a 30 or a 60 minute with a nice symmetrical pattern. Usually it's going to be a bidivergence or three pushes. This was three pushes. This was our ante, which is that first higher low, or perhaps a continuation pattern, such as a flag or an ABC continuation pattern. See how much cleaner on this 15-minute chart it looks than this 5-minute data. Now, you can still watch the 2-minute charts or the 1-minute charts or the 5-minute charts, but you are watching it now with intent. You are watching it with intent of seeing if this bidivergence here starts to catch hold. So if you're watching the short-term action with intent to be a buyer, intent to find support or resistance, it's going to make all the difference in the world for you. And let's just take another example with the hourly charts. Here I'm using just pit session data, so that's fine. I actually like to use tick data as well, so we will look at that in just a minute. But you had pretty clean swings. Granted, it's harder when you get these gaps, but we were forming this double top on the hourly charts. And it was a sort of quasi cell divergence type of feeling there. But look at this mess up here. Yes, in hindsight, we can start to see the triangle forming, but it is far too easy to get caught up and chopped up in this. But if I'm watching this with intent that we're starting to roll over here, then it is much easier for me to start to frame out levels that would be confirmation of downside. For example, I love it when the market leaves a tail, a candlestick type of tail, and I guarantee that this was a big fat tail. And when we start to go back down into those tails, I call it eating the tail, and it usually leads to continuation. And this is exactly what happened there. So it all looks great after the fact, right? But that is the whole point of real time learning. That's where you are going to get your most value in your own personal growth curve. I could talk till I'm blue in the face and show you chart formations and levels and things to be aware of and little tricks with the VIX and time of day functions. And I could really talk for 12 hours straight. And you know what? It's not going to mean one damn thing until you start to see this on a walk forward basis. And that is where the learning really comes in. And it's not easy at first. You have to do trial and error, and stay on your smallest size only until you start to find a little groove for yourself. But this is how that unfolded. And here's another thing to keep in mind: there is not one right or wrong way to trade. There is not one right or wrong style. The only wrong thing is not putting in a stop and managing your trade. That's the only wrong thing. So there is not a correct way to trade. Every person finds their own little will be looking to short the tests or the failure test up there. Okay. The aggressive trader is going to be putting more attempts into the trade location, and it may or may not work out because they do not have confirmation at this point. You can see on the hourly charts, all we have are 3 bars of price overlap here. But a very aggressive trader is going to be focused on watching every tick and for that test reject above that high. And a conservative trader will either wait for the market to tip its hand. Perhaps they're going to sell somewhere down here into this tail or sell stop. Or perhaps the most conservative trader would wait till this made a new low and look for a little reaction. So all of these are a trade-off. An aggressive trader might get stopped out more often, but might have better trade location. And in the long run, I find that some people like to initiate by buy or sell stops, and other people like to see their spot, see that the ticks are high, the market stopped going up or down, and bam, bang it out at the market. All right. So even if you are to miss one stop in a good move, you will at least get one little small flag once that market has tipped its hand. These days, the market is very efficient. What does that mean? Efficiency. We have these alternating extremes between noise versus efficiency. And that is when the market has tipped its hand, when that horse leaves the barn, it is dog pile in or dog pile out. So this type of price action down here is very efficient. And if you are the type of trader that likes to initiate on a small pause or reaction, the only way you're going to be able to do that is with looking at a 1 or 2 minute data, or some other type of cue. So the preparation, even if you aren't making trades in here, the preparation of noting that here is this resistance area on the hourly charts. This market's been channeling up for a while. This is a very key reference point, and that's, I don't know if it's algorithms or just the fact that every trader sees these visible swing highs or swing lows, but I guarantee that this is where the volume came in on this big down bar. Okay, just 1 or 2 more. I told you that I also use tick charts. I never go below a 4,000 tick chart. When volumes are really high, I'll try to stay on like a 6,000 tick chart as my primary chart, such as meaning a 5 minute chart, or something that's going to monitor just the shorter term swings. So I like a 4,000 tick, anywhere between a 16 to a 20,000 tick. If the market got ridiculously light volume and slow, I make it a 12,000 tick, but it's kind of this feeling of a 5 and a 15 minute chart. Okay, something in that range that works for you. And then I always like my big picture 60,000 or 80,000 type of tick chart just to see the levels. I just want to know the high and low levels. So once again, we have our roadmap on the higher time frame, meaning the chart formation. Examples of that, you guys all know: a buy or sell divergence, a flag or continuation pattern, or lastly, some type of wedge where we've got converging trend lines. And this was a good example of a wedge at the end of a swing. So wedges, or terminal wedges, however you want to call them, come at the end of swings. And of course, we're not talking big daily swings, we're just looking at the intraday data. So we had the rising wedge. In hindsight, you can see the little bit of a divergence. You aren't going to see this divergence right at the time, though, I promise you. The bar is going to have to turn. And here's a little secret: when you're looking at oscillators, don't wait for the flip up or down on the oscillator, because the price will always turn first. You'll get either one or two bars, and that's going to pull the oscillator up or down because they are a derivative of the price. But we want to be aware of the general shape, like you could see clearly on that previous 15-minute chart, the divergence that was setting up. So you see this rising wedge, okay? We just know that eventually there's going to be some type of exhaustion up here. And on our shorter term time frame, I'm very much one that just sticks to these highs and lows. You can see once again the oscillator's pretty useless here. And I find that to be true on the shorter time frames when you get these test reject patterns. You could call it a, um, a, uh, a you've got spring and upthrust terminology from Wyckoff. You could call it a bull trap. You could call it, a false breakout, and then it comes back down, and to the middle of the range would be our first objective there. However you choose to use the semantics, the point is that this was the last hurrah into this type of chart formation. And now it's a matter, are you going to jump on board at the market? Are you going to put a sell stop here? Are you going to initiate on the first flag? We do know at this point that we have the wind behind our back. So always think of that when you are doing your trading on any time frame. Even if it's a daily swing chart, you want to be thinking then that you've got the weeklies as the wind behind your back, and it'll save you so much grief. So I love the tick charts because they also show the continuous data. It condenses the night session, and you get very, very clean chart formations, unless, of course, it's a slop and chop day like today. Lastly, we've gone through our type of day. Are we expecting range expansion or consolidation of a previous trend day? Perhaps it's the day before an FOMC or a big announcement and volumes super light. We would expect a trading range day. And on a trading range day, that means don't get caught up in looking for false breakouts. Okay, so that would be a perfect example of today. The second thing, levels. Mark off your highs and lows. I don't have the levels marked off here, but you can kind of get a basic idea that this was the previous day's low here in the NASDAQ, and we gapped down and came back up to test that low. So that's a pretty common trader go-to. Many years ago, Larry Williams used to call this the oops trade, okay? And he would use these points as initiation points, that if a market gapped outside the previous day's range and came back up to that low or high, you would then initiate and buy because everybody would be trapped. Unfortunately, that simply does not test out anymore. Some of these things change over time, but it did work very well 30 years ago. And I just love that name, the OOPS. So we had the OOPS in the S&Ps and the NASDAQ. And then you see the non-confirmation. So this is the very last ingredient. We had type of day, levels, our little time of day functions, the market internals, and chart formations. And so I did two things for you here on this last chart. First, I wanted to show a classic example of non-confirmation where the S&Ps make the lower low and the NASDAQ makes the higher low. So this is non-confirmation. And then I also wanted to show you an example of confirmation. So the S&Ps break down and take out these previous little lows, as does the NASDAQ. So this is confirmation. And to me, this is green light, go. I'm waiting for a chance to put on the volume and the size and step on the gas pedal when I get that confirmation. Sadly, we don't nearly get it as often as we would like. So for when we get those openings, okay, how many of you have played tennis and your opponent is pulled off court or off balance? Or perhaps you play football and the one team fumbles the ball or you catch an interception, okay? That's an opening. And that's where you need to convert. And so this game of trading is no different than game of sports. You're keeping the ball in play on that tennis court and waiting for your opponent to be pulled off so that you can then put that ball away. But you can't force hitting winners. And so it's only with time and more time under your belt that you start to build up the confidence that you can see and feel these green light goes, and you might only get one of these a week. Every person I have known that has made a living day trading, and yes, I do know some, and yes, it took them many years to solidify their game, but they will tell you that they might make 80% of their profits on 20% of the days. And the rest of the time, we might be making small pocket change. We might be making small scalps. You might be having a sloppy day and you give back some, hopefully not too much. Okay. You might make one or two unforced errors, but it's really important in this business if your ultimate goal is to be able to make a living doing it, which takes a lot of consistency. If your ultimate goal is to make a living, you need to be able to recognize those select times where the odds are more favorable, you have that green light go, and you can convert. Okay. So I also wanted to see, I got the header here. I got my two charts mixed up because this was the header from that other chart, tick charts. So this is what happens when you're trying to trade and pat your head and rub your stomach at the same time, juggling a lot of balls in the air. But down here, I just put a stochastic for you just to show it's going to give the exact same swings that are another oscillator would, for example, my 310 oscillator. The traditional MACD is much slower, so it's not going to capture the short-term little divergences like this feeling might, okay? But they all have their strengths and weaknesses. For me, I
But I
like to
do
use them
find
as a
that they give me a lot
metronome.
of extra.
Okay, now we turn up. It's just mirroring the swing. Okay, it's just mirroring the swing. And over time, you'll find that you will be able to follow the swings up and down without the oscillators. But I do find that they give me a lot of extra confidence around those divergences. The one thing that a stochastic or an RSI or a banded oscillator is not going to give you is that new momentum highs or lows. And that's the difference between the moving average oscillators. So here, when you see we break down hard and we're making these new momentum lows, what will typically happen with a banded oscillator is that it will flatline. So it'll just stay buried down here. And if you see a buried oscillator, the first reaction up is a 90% trade for a test back down. I suspect that some of you know what I'm talking about. And if you make it a point to look for that going forward, if you do use a stochastic, you'll get the hang of that super quickly. Okay, with that said, let me just wrap it up. Oh, golly, I don't need the copyright notices for this. Um, we actually have a little trading room that Damon and I do. You are welcome to go check that out on my website. I would suggest it's not for beginners per se, because we do a lot of trading in crude oil and gold and stocks and other markets. However, if you have not been as experienced in the markets, I am going to do a special workshop that is just going to be on S&P trading. And it's going to be down deep and dirty and getting into all these little patterns that I have kept notebooks of for 40 years, the time of day functions, the afternoon patterns, these little subtle nuances when the VXX makes new highs or new lows in the afternoon. How do we recognize these cues? Okay, the action around the highs and lows, and we'll be making trades at these points then for the following week. So if you want more information on that, you can also find that on my website. Now, with that said, I'm not here to sell stuff for you, so I instead would rather spend time taking your questions. And the first question that I see is, when does the previous day's high or low begin? So for my purposes, when I mark these things off here, I am using the previous day's 24-hour session. Yes, the pit session is important as well. We are cognizant of the pit session highs and lows, just like we are the Globex highs and lows. But you'd be surprised, a lot of charting platforms don't break it out. For example, with TradeStation, I have a TradeStation program, and I can put in the symbol ES.D, and it will only give me that daily
If I
data,
can
the
even
pit
slide
session rather, the
something
US
over
pit
onto
session.
my
With
screen and show
CQG,
you
I
what I
can't do
am
that. And
talking
there are a
about
lot of
here, I
software
bet I
programs out
can.
there
I'm
where
going to
if I
just
were to go
do this
and
real
look
quick
at
because
daily
I
candlestick
have all
bars,
kinds of
all right, I wonder
up
if I
my
can even
sleeve.
slide
I'm going
something over onto my screen and show you what I am talking about here. I bet I can. I'm going to just do this real quick because I have all kinds of tricks up my sleeve. I'm going to simply pull over here. So can you guys see that? Okay, so this is daily data of the S&Ps. And I don't get the luxury of seeing the uh, pit session broken out here. So I'm only looking at the highs and the lows for that 24-hour range. And those are my first go-to. Then I've got the Globex highs and lows, and then the pit session highs and lows. Okay, my website is lindarashke.net. Okay, where do we place our stops? Not to give a smart aleck answer, but I had a friend once when I was first trading on the floor in the 80s, and at the time, this was when the S&Ps first came out, and I said, Ron, how do you know where to place your stops? And this is true story. He said, how much money do you want to lose? Okay, well, obviously the answer would be, well, I don't really want to lose any money, but we are in a risk business. So you have to give the trade a little bit of room to breathe. Where I place my stops is going to be dependent on the type of trade or formation. For example, if you have a buy or sell divergence, you would never want to see it go below that low once it turned back up. So there are some cases or patterns where we can use a super hard and fast stop at that previous swing low. There are other cases where we have a, let's say, a continuation pattern, and you can't time this to the tick. You have to give the trade a little bit of room. So on continuation patterns, let's say for example that this right here, it's a 2-minute chart, but just use your imagination and pretend that you've got a little 5-minute chart. I will put it halfway between the moving average and the Keltner channel here if I've got a channeling market. Granted, this is a 2-minute chart, but um, pretend it's like a 5 or a 15-minute. If it's a continuation pattern, you really don't want to see it go back to this halfway mark. So that's also a really crude way of doing it. The last way of doing it is pick an absolute hard and fast number. This is my go-to that I've always used in the past. I'll just throw a number out there. It's not necessarily relevant to today's volatility conditions, but let's say that no matter what the market was, I was always going to risk no more than $500 on the euro currency or the crude or the bonds or the S&Ps. That is my hard and fast stop that I put in. It's called an initial stop. An initial stop is there just to protect you against the flash crash and giving the room a little bit of, the trade a little bit of room to develop. And then once the market starts moving off in your direction, trade management should be an active process. Once the market moves in your direction, you can trail that stop up a little bit, or at least tighten it up to the last low, or tighten it up to lock in some profits once the trade gets underway to protect yourself from giving back open profits. Obviously, you can't do that too soon because there is a big noise level these days, and you don't want to get risk jiggling out in the noise. I shorted it this morning at above that I don't know, it was 22 handle or something we were trading up there, and I made that mistake. I had the initial stop of 24 and we sold down a little bit, and I pulled my stop down. I think it was like 22 and a half, or I got tagged to the tick on that stop. Like you didn't even see it trade there, and then boom, it just fell right down. So that was a case of me, just getting a little bit too eager to manage that trade, and that happens. Um, at any rate, it's also going to depend on the overall volatility environment. So that's about all I can say on that for now. Am I going to rewrite George Douglas Taylor's book? Wow, it's like when I do get around to rewriting it, it's going to be the new modern theory of Taylor, because it's people mistake his book method for being a literal thing, but everything he says in there is still a gem. In particular, the way the price trades around that previous day's high and low is as relevant as ever. And is it a low to high day or a high to low day? Or is it a case where we just had a good day up and it's a sell day, meaning you're not trading with a directional bias. You can trade in either direction. You might want to exit your longs, but there might be a chance to rebuy, and so forth and so forth. So this 310 oscillator that you see here on my screen is the difference between a 3 and 10 period simple moving average. And it should be on Thinkorswim. I don't know if they call it 310 or LBR or something. You would need to ask their support staff about that. It's just sort of my go-to. I don't know if it's any better or worse than any other oscillator. And yes, I love the anti-pattern. What is that anti-pattern? It's really the first higher low
Slow line turns
or the
up.
first lower high before a true trend has developed. And this is kind of a dweeby little chart to look at. It's not going to be as meaningful on 2 minutes, but you can see where the slow line turns up and you get that little pause and then it springs back up. So, again, let me just see if there's something in here somewhere. So this is more of the buy ante type of feeling where the slow line's pulled up and we get that first higher low. I'm kind of forcing it a little bit here. Usually they look like a little flag and it can lead to an A, B, C. So for those of you that have seen some of my previous lectures for the Money Show, I do believe that there was one where I talked about latching on to this ABC rhythm. Don't worry about capturing the low. Let the market make its first play, then consolidate and give leg to. And this just is not the ideal example. This data was there to pick something else out. You can see there are times that we just disintegrate into nothingness. This would be pointless to be concentrating too hard on chart formations here, but yes, I still use that anti. I love the divergences, I love the anti, I love the ABCs, I love the simple flag formations. And the thing to keep in mind, gang, is that if you were to look at a 5-minute chart, be honest with yourself. Be real. Go back and look at 10 days worth of data and then answer, how many clean 5-minute patterns did you see? Okay, and that is the whole trick to day trading, is the patience to wait for a recognizable pattern. It took a lot of patience for me today to sit on my hands and not get chopped up. But on the other hand, we had some other really great trading markets today. If you were trading the Russell, which I wasn't, but that was really where you would have wanted to be trading in the index futures. But some people like to trade the gold or the crude or the bonds or the currencies, and all of these had really recognizable patterns. Mayor Offman's strategy, holy crap, you don't want to mention that name. I think he totally blew out or something. It was that's pretty awesome. I love the fact that you remember that. That was what, maybe 25 years ago? Okay, Clay, you are dating yourself. I don't even remember what his strategy was, to be truthful, because he did a lot with options. It had to do with, I think, something along the lines of putting large positions in stocks where there was a skew, or pairs trading or something. I don't even remember. You tell me. Okay. All right. So
Hey,
you
Linda.
got me here. I'm still willing to sit there, and I love interacting with you guys. It's always really interesting because I get a chance to see what you guys are looking at. Wait, go back. Okay, there was in conjunction with the tape, you used standard volume bars. Okay. Is there any way, Debbie, that you can go back and let me
Oh,
let me
did you leave the room? Did
I
you
know, you
refresh
know
it?
what? There was somebody that asked questions on a volume thing. And by the way, if you guys have any questions on the difference between the workshop or the trading room or overlap between the two, send me your questions. Send me your questions on technicals. I wouldn't give a webinar like this if I didn't feel the need to clarify things. You can go to my website. There's a contact me button, and I am happy to answer any of your questions. But I was starting